it's always about, well, are there strategies, are there techniques that we can use that actually can help us in times where we have elevated volatility, and so that we don't have to run for the hills and go to cash.
And when you talk about run for the hills and go to cash, not too long ago, you were interviewed on Investing News, I believe, and you talked about the drive to gold. And the phrase you used, it seems very basic, but it is very honest. When people fear the return of their capital, they look for safe havens in which to park it. And the safe haven was not the U.S. Treasury, it would appear. It was gold. Is that going to continue, do you think?
I think at the moment, all the signs are pointing to the fact that it's still a very positive environment for gold. And when you consider the reasons why, I think number one, the thing that motivates investors more than anything else is what I call the fear premium. So this is, as you rightly pointed out, Adam, this is the fear of your capital being returned rather than necessarily a return on your capital. And the fear premium motivates investors like nothing else. And of course, when you have this kind of environment with elevated volatility, where you have a trade war going on, uncertainty around which direction the market is going to go, investors are looking for something which is not traditional stocks or bonds. And gold is typically one of those assets, if not the asset that people go to in times of distress. So that's the number one thing. The number two thing for me is if you look at the chart of global M2, so this is the money supply, in other words, the issuance of paper money against the value of gold, you can see it tracks very closely. So sometimes I like to think of it as not necessarily that the gold price is going up, it's more that the value of paper money is going down when measured in gold because of all the money printing, the debt explosion, et cetera, with governments across the world. So I think these are kind of the two things that are really contributing to the rise in gold at the moment.
Well, Dr. Feeney, let me speak to you about the fear premium. Because in the talking points that you shared with us, you talk about the S&P 500 may be in for a rough ride, but that doesn't mean all stocks are going to suffer. And my favorite, McDonald's, is one of the stocks you would point to. And yet this is a global company. So how does the fear premium play into the future of an asset like McDonald's?
Yeah, the fear premium is that some stocks have become more risky than others. And in this environment, with this kind of a trade war, we're seeing input prices go up. Right? It's certainly the case that tariffs on final goods are going to create shortages. They're going to create higher prices, but more for investors, you want to look at what it's doing to the prices of parts of the intermediate goods that companies need to make the stuff they ultimately make and sell. And so one way to steer clear of those risks of what those what that rising cost is going to do to their profitability and therefore their earnings and therefore potentially their stock price is to look for companies that have less exposure to imported inputs. And McDonald's is a global company, there's no question. But when you look at how they operate in the locations where they have shops, they're sourcing locally, so they're less exposed, right, to the changing taxes on imports than other companies would be, and also just more resilient. Even in a recession, McDonald's tends to do just fine. People continue to go to McDonald's. In fact, other people that would have gone to a higher priced fast food place will trade down to a McDonald's. So it's a pretty resilient stock to hold through tough economic times.
You brought up, though, sourcing local, and I'm going to throw this question to both of you. I'll start with Dr. Feeney. There seems to be a backlash, though, even if they're sourcing local, and I heard this in a discussion on CNBC about Coca-Cola, that even though most Coca-Cola is manufactured in the region or the locale where it's then distributed, it's associated as an American brand. It's iconic, as is McDonald's. Is there, because of how people outside the United States may be viewing the United States right now, is there backlash that could impact a stock price? First, Dr. Finney, and then you will.
Yeah, no, I think that's certainly a risk. I think that risk is not one to be completely ignored, but I think the benefits of their cost structure is probably a better, more resilient feature of the company's profitability. We do certainly worry about boycotts. We worry about them for not just McDonald's, but also Disney and Coca-Cola. And so you have to weigh the risks there. Disney, for example, we sold recently because not only do they have boycott risk abroad, but you've seen the significant drop in international travel to the United States. And so, we see Disney parks at risk from a drop in attendance.
Will?
No, I agree. I think, I hope that if we're talking about anti-American sentiment, around the world, I hope it hasn't elevated to the point where people are stopping drinking Coca-Colas or going to McDonald's. But that certainly could be a risk. I think I see it more manifesting in the drop in travel. Things like people not wanting to come or electing not to come to the US or selecting alternative venues for their vacations, etc. But I don't think it's quite at the level yet where we see, or I hope it's not the level where it's manifesting in actual, people boycotting brands in the way that that I suppose could happen.